With an uncertain start to the week and a quiet start, let's see if things have picked up. All with Bob Mason of FX Empire. This is the Midweek Wrap. Hello, Bob, and thank you once again for joining us today. Let's start by focusing on the US, the UK, and the Eurozone. How's it looking on the economic calendar side?
After a relatively quiet start to the week, gets a bit busier in the second half of the week on the economic calendar. For the US, we've got inflation figures due out on Thursday and retail sales figures due out on Friday. The Fed's been a little bit concerned with softer inflation figures, so there'll be some attention on that. But really, the focus will be on retail sales figures on Friday. Domestic consumption remains key. With low interest rates, low mortgage rates, solid labour market conditions, there's no reason for consumers to be tightening the belt anytime soon. Consumer sentiment figures also due out on Friday should reflect any shift in sentiment, however, over the spread of the coronavirus. So that will be a telling sign whether there's any concerns from consumers. We heard from the Fed chair on Tuesday in his testimony that should economic indicators continue to show US economic resilience, then they'll stem pattern policy. So we're expecting inflation figures to stay relatively steady and a pickup in retail sales figures. All in all, which should be US dollar positive. Looking across to the euro, it's not been a great week. We've seen the euro take a slide. It's back to sub 110s against the dollar. Economic data out of the Eurozone continues to disappoint, particularly the stats out of Germany last week, if we discount survey-based data that we saw for January. So looking ahead, after today's industrial production figures out of the Eurozone that we expected to be soft, we've got fourth quarter GDP numbers out of Germany to look at on Friday. Now we can expect particularly sensitivity to the numbers. Any contraction, obviously, we'll expect the euro to slide further. There's a world apart between the two economies. US economic resilience is expected. The Eurozone economy, however, is a little bit more dependent on China and trade across the region. So if the coronavirus does have a material impact on the Chinese economy and within the region, then expect the Eurozone economy to suffer. And that suggests further downside for the euro. Looking across to the pound, there's no more stats out through the week, so focus returns to Brexit and trade negotiations. We've heard from the EU they're looking for a spectacular trade agreement with the EU while mocking Boris Johnson, really, and his no strings attached calls. So it really remains to be seen who comes out on top. One thing's for sure, Boris Johnson's unlikely to accept any strings, so if the EU doesn't buckle, then we may resort to WTO terms, and that's obviously pound negative. There is one caveat, however. Within the Eurozone and the EU, there's some geopolitical risks rising once more in Italy and Ireland, and even in Germany. So the last thing the EU needs right now is for the likes of Britain to successfully negotiate trade terms elsewhere and even move on and not need the EU as a major trading partner. That would be quite a coup for Boris Johnson and would raise questions about membership of other member states. So near-term pound upside probably quite limited, really because of the uncertainty. Euro, it's under the hammer right now. The dollar's looking quite favourable based on the economic data that we've seen to date.
It's been a relatively quiet start to the week across the board, but in particular with the commodity currencies. Can we see an upturn?
It's been quite a week for the commodity currencies. Through the start of the week, we saw a material shift in sentiment towards the coronavirus and the spread that shifted demand for commodity currencies and riskier assets going into Tuesday, where equities started to go on the bounce once more. Economic data through the start of the week was on the lighter side. When we look at the Aussie dollar, we had business confidence and consumer confidence figures to look at. Following the RBA's more hawkish than anticipated outlook on the economy, and also rather calm view on both the impact of the bushfires and the coronavirus on trade. This morning's consumer confidence in particular was impressive and provided further upside for the Aussie dollar. Business confidence held fairly steady as sentiment improved. So all in all, that's aligned with the RBA's outlook. All we need now is a pickup in wage growth and rise in consumer spending, and the RBA is off the hook. For the RBNZ and the Kiwi dollar, RBNZ stood pat on policy as we'd expected, but again, RBNZ was also hawkish on the outlook for the economy, with growth expected to accelerate through the second half of the year.
Good point.
The RBNZ also doused any major concerns over the spread of the coronavirus and spread, and even with the New Zealand's reliance on China as a trading partner, that provided a strong boost for the Kiwi dollar on Wednesday. That came despite weaker than expected retail sales figures. Retail credit card sales fell rather than rise as had been forecasted. Later on in the week, for the Kiwi dollar, we've got business PMI numbers. We can expect the Kiwi dollar to have a little bit of resilience to any soft numbers, however, particularly with the RBNZ outlook on the economy. We're expecting some softness through the first half of the year. There's nothing for the Aussie dollar. So all in all, it's all about sentiment towards the coronavirus and whether China can turn it around. Expectations are for a massive stimulus package to offset the negativity through the first quarter. Going over to the loonie, there's no stats. Beginning of the week, we had housing sector numbers that really had a muted impact. Again, we saw oil prices slide and they're bouncing back, although the jury's out because there's some debate over whether OPEC and Russia will cut production to meet the fall in demand that's anticipated. So there's a lot relying on that. Commodity currencies not out of the woods just yet, however. Market concerns over the rate of contraction, the rate of catching the virus may have eased, but the numbers don't really tally up, and there's some debate over whether these numbers are actually particularly accurate. So if the spread continues beyond China and those numbers start to rise at a more rapid pace, then expect risk aversion to return.
And lastly, one subject we can't escape is the coronavirus. Slowly but surely slowing down maybe, but how's that having an effect on the Asian markets, in particular Japan and China?
Looking across at the Japanese yen, we've seen the yen soften this week. That's as risk aversion abated and sentiment towards the spread of the coronavirus and the pace of infection eased, and the rate of mortality was reportedly down at 0.1%, which is in line with the traditional flu. If those numbers are accurate and we don't see a marked acceleration across other countries, then the yen's on for a further decline as risk sentiment improves. There is obviously the caveat, however, that we could see a marked pickup in infections and mortality rates that could give the yen a boost back to 108 and even 107 levels. There's no stats to consider in the remainder of the week, and really there was nothing to factor in at the start of the week, with current account numbers doing little to shift the dial. So all in all, it's all sentiment on coronavirus, and at the end of the day, the markets are expecting a marked stimulus from Beijing to support the Chinese economy. So if that's delivered, then that should ease the yen further. Looking at the Chinese yuan, obviously it all hinges on the numbers and how the Chinese government relays the message on how it's handling the virus. All in all, we've seen the yuan go back to sort of sub sevens against the greenback as it's picked up some strength. We saw inflation pick up at the beginning of January, so that supported the yuan. And we've got loan growth coming out at the end of the week, so that will be of particular interest to see whether there has been the expected jump in loan growth. So if there is, then that's suggesting that the Chinese government is providing the necessary support. But expect the coronavirus numbers and risk sentiment to really drive the yuan over the remainder of the week, with nothing else really to consider other than loan growth.
Well, that's it for today. Thank you once again for joining us, and we will see you again next time.